Morning, my name is Varun Chakravarti. I'm the founder of Canopy. Canopy is an online community that connects customers to licensed dispensaries. I founded the business last year, and I'm currently in the process of fundraising. And like many of you, I wanted to get a better understanding of how the investment community views the investment decisions, what the due diligence process looks like. And so I have an amazing opportunity where we've assembled a panel of some of the best mentors and investors in the Boston community to help us answer that question and to give us greater insight. And so today I'm joined by Payal, who's a partner at Point 406 Ventures. I'd love to give her an opportunity to introduce herself, and then we'll introduce the rest of the panelists.
Sure, good morning, everyone. I'm Payal Devakaran at 406 Ventures. We're a Boston-based VC firm, been around about 15 years, managing about $1 billion of capital across 4 core funds and 2 opportunity funds. Our 4th fund we raised last year, which was fortunate timing. And our stage focus is Series A. So typically when companies have achieved a level of product market fit, and usually have revenue and some customers. In terms of domain, we focus on digital health, and I co-lead that practice, cybersecurity, and data and cloud. So we're sort of a B2B focused firm with an even more specific focus within that. And like to do a lot of things in Boston and New York. So looking forward to this discussion and seeing how I can be helpful to the audience.
Wonderful. Next, we have Nancy from who's a technology scout at BAE. So if you could.
Hi, I'm Nancy Saucier. I'm the Innovation Initiatives and Strategic Partnership Lead at BAE Systems, which is a large defense contractor. I specifically work in the Fast Labs division, which is our innovation and R&D division, primarily focused on both internal innovation as well as external collaborations that help us to bring new innovations to our technologies. Prior to this, I actually managed something called the Riverhawk Venture Fund for UMass Lowell, which was a small investment, alumni-run investment fund out of the university. So my focus was primarily in angel-style investments and spin-outs, university spin-outs.
Wonderful.
A little different today, though.
Wonderful. Next, we have Vineet, who's a managing director at Mass Ventures.
Thanks, Varun, and hi to everybody out there, and also my fellow panelists. I started my first company when I was an engineering student, and my companies have been acquired by Boeing, Motorola, Qualcomm, Mitel. 13 years ago, I decided I'd move from being a parent, running companies, to being a grandparent, helping others. And that's really taken 2 forms. One, I teach at Boston University, so I've created some courses over there. And secondly, I invest, and mostly focused on deep tech and even more focused on academic spin-outs.
Wonderful. And then last but certainly not least, we have Jennifer, who is a managing director at Pickaxes and Shovels.
That's right. So I'm Jennifer Jordan. I'm an early stage investor. Previously to this, I was at Mass Ventures, the state of Massachusetts venture capital fund, where I led investments in Ginkgo Bioworks and companies like Machine Metrics. So usually data-driven software companies. And I also do a lot of work with Techstars. So I'm the EIR right now for Techstars Future of Longevity program, which is focused on aging and technology. And I also mentor for the Techstars Montreal AI program, because my current interest is in raising a new fund focused on AI trust and transparency. So that's what we're up to.
Wonderful. So before we dive into the set of questions that we have today, what I would like to do is start with the poll. What I would like to do is help to understand what the audience makeup is to help contextualize the information for them. So James, if you could run the poll, please.
Just read the fine print that I can't vote.
We can't direct message any of the panelists either. Huh. Okay.
No. Keeping us honest.
Keeping us focused.
Darn it. That's like one of the most fun parts of this Zoom experience is you can direct message, you know, out into the world.
All right, wonderful.
Wonders.
So just to, you know, kind of summarize the information, it seems that just a little less than half are founders or employees at a company. And then about 20% is investors, and then about 20% other. Wonderful. So mostly founders. So to begin, I think what I'd like to do is just open up with a point blank question, which is, you know, what does the vetting process look like? Nancy, would you mind telling us a little bit more about what that process looks like?
Sure. You know, so I mean, you kind of look at a lot of different factors. I tend to focus a lot on team and team dynamics, the clarity of the plan, and ability to drive to certain milestones and making sure that those milestones make sense. Some accomplishments prior to you know, to a first round of financing, you know, demonstrating that the team can actually execute. I definitely care about the other investors or potential investors in an investment. And so you definitely take a look at the financials, existing financials plus the projections. And so, you know, I guess those are the big buckets or categories. The technology, I'm not a technologist, so I tend to be pretty dependent on my co-investors to really vet that technology and make sure that it's sound. But I do have quite a bit of experience reviewing the intellectual property and what that intellectual property strategy is. And I think that that's a factor as well. So I know my other colleagues may have other things that they prefer to look at when vetting, but I would say that those are the major buckets and categories where you got to make sure you know what your answers are, and that the philosophy behind it and the strategy behind it is sound.
Wonderful. And so, you know, given the makeup of the attendees, do you feel that the process changes for early stage ventures versus those that are later stage? And how does that vetting process adjust? Jennifer, could you speak a little bit to that?
Sure. I guess what I would say is that when you're at the very, very early stages, sort of from the piece of paper to that first pre-seed, seed round, you're really looking a lot at the team, and then those, and at your ability to execute, the pace of execution, is the opportunity big enough, right? And all the quick experiments and things you can run that give me confidence that you can make progress, right? Once you get to the place where you're starting to have product market fit, then I'm really starting to look for you to understand your business model, how you're going to go to market, what the drivers are in that model, and to start to have some sense of your revenue and costs. So that it does change as you get into product market fit, and as you get into the place where I'm thinking about, can you now scale? And maybe Pyle, you're better to address this question because you're working closer to Series A and with some companies now that are post Series A and your follow-on.
Sure. Thanks, Jennifer. Yeah, no, I think that's right. I think that the criteria becomes a bit more refined and metrics driven as the stages evolve. And so for Series A, we are looking for a little bit more precision around the elements that Jennifer mentioned. And in particular to our firm, we're very maniacal about sort of hard dollar ROI. It is so hard to sell into enterprise, and in my case, into hospitals particularly now, and payers, that for every dollar that you charge your customer, we have to see the path for, you know, $2 to $3 in return for the customer and that value prop. And so founders who don't have that refinement really struggle to advance in our process. I'll mention a couple other things that I think are underappreciated, because you hear all the obvious, like, let me list the 10 things that I look at, which I think it's helpful to restate, but a couple of things that I'd underscore. For not all companies have to be venture funded. You know, most companies are not, in fact, right? It's beautiful business if you can sort of bootstrap it yourself and own more of it. But to be venture funded, the market opportunity has to be massive. And you have to convince a VC about that. Why is that? Because we're going to own a small percentage of it, and I have to underwrite to the money that I put in, seeing a 10x return. And if I own a small piece of your business, for me to get that 10x return, you've got to scale. I have to see a path to sort of $100 million of revenue in, you know, some time frame that's less than 10 years. And so it's got to be a big market opportunity. I think, you know, that's sort of one thing. And then the second thing that's sort of underappreciated in the process is sort of the softer part of it, which is like, this is like dating. I mean, if you ask someone like, what are you looking for to find, you know, your partner? You know, they could tell you all the things like, I want some good looks, but at the end of the day, it's about fit and chemistry, and can you spend the next sort of several years together in the trenches, and in our case, on the board together, through thick and thin, excuse me. So there is that softer side of it that we are evaluating, sort of the personal relationship, the personal fit, the coachability, and all of that about the entrepreneur as well. And then finally, in terms of our funnel, we're seeing about 1,500 opportunities a year, and we invest in about 10.
Okay, wonderful. I love that. I love that insight into the mind of the investor and just kind of that framing. To build on that, you know, since you mentioned, you know, the relationship is like dating, what are the things that you look for in a really, really good investment? And what are the things that are red flags that would, you know, tell an investor this is probably not the best opportunity for us to invest in? Pyle, if you want to build on that, and then I'll switch to Vineet and have him also add some additional information.
Yeah, I'll be really short so that I'm interested in Vineet's input on this as well. But, you know, we are looking for, usually that person has a deep understanding and has lived the problem. And so it kind of makes sense for that person to be attacking this problem. And therefore you see the passion for it, because you need that passion. The company is going to ebb and flow in 100 different ways, and it's going to be a roller coaster. So we look for that sort of intrinsic passion or motivation. And then coachability and the ability to sort of debate in a healthy way is really important. I mean, if it's sort of the entrepreneur's my way or the highway, that's just not going to work, because it's a partnership, and there's going to be a lot of push and pull. So we do look for those. But Vineet, sort of over to you. I'm interested in sort of your criteria.
Well, you know, it's a couple of points. One, it's very interesting to see how the venture capital industry has evolved. You know, there really was no such thing as a seed investment, you know, in the 90s. You started with a Series A, and you went on. Then we got this concept of seed. Now we have a concept of pre-seed. And so in a way, I think what the market is signaling is that it's incredibly hard to predict product market fit, right? When it really comes down to it. And you know, we investors invest in data analytics companies, and you know, we think ourselves as being very kind of logical in the way we approach it. But all the data suggests that investors make their decision, you know, within 15 minutes of meeting somebody, right? With it, and then all that due diligence they do, in some ways, is, you know, trying to confirm that, you know, that gut feel. And that gut feels a lot around what Pyle just said. It's all about, like, can we work with this team or this leader? And I think there's an opportunity to evolve beyond that. I don't know what the answer is exactly. You know, most investors at very early stage are going to focus primarily on the management team, right? It's, you know, it's so hard to predict market timing. especially with, you know, the world I am in with deep tech technologies that are spinning out of universities. It's incredibly hard to predict market timing. And it's also incredibly hard to sort of look at the science and see if it can be engineered. You know, you try to reduce the risk there, but it's very hard to do. So ultimately, you are looking at the people.
Okay. Yeah, I guess I'd like to pile on to that just a little bit. This idea of team and the importance of team, particularly at the pre-seed, or what I would call, you know, 2 founders and a dog is everyone's favorite little definition of a pre-seed startup team. I'm actually okay with, I agree with you. You have to have rapport with those founders. You have to be convinced you can work with them long-term, because you are in it for the long term, and there are going to be big dips and flows and pivots and things like that. And so you have to intrinsically believe that the two of you can, that you can work through that with them. But also common, particularly at the pre-seed stage, is teams that are incomplete. And that's okay. But having the founders understand what's missing, why it's missing at that stage, and when they might need the addition of a particular team member to round out what they have done some soul searching about and understand that they are or are not good at doing, right? And so I'm really okay, because no pre-seed team is complete. And if it is, then I look at it more as a lifestyle business, right? It's, you know, 5 guys that like to work with each other and, you know, golf with each other and are thinking, you know, hey, we can all, you know, pool here and do something. I'd like to see a little more skin in that game, but so that's one thing that I would emphasize is it's okay to understand what you are not, particularly as your business grows, evolves, matures, and know when you're going to add team and when it's not appropriate to add team because of burn rate and some of these other things. And so thinking about team completely and how it floods into the entire rest of your model, I think is important as well.
So I'm going to pile on with my one favorite flag,
Sure.
which is I had a very hard lesson as an investor, and now I try to really surface this early, but a really important driver for me of team success is that each member of the team has a strong and healthy appreciation of the value of the other functions and what people bring to the table. And this, I think, is particularly important when you're working with deep tech and hard tech, because I have seen maybe too often a technical founder who doesn't have enough healthy appreciation for the value of selling and the sales team, and then doesn't listen well enough to the feedback that's actually coming back from the market. And I can see it go the other way, where a salesperson is not listening to a technical person tell them, like, hey, you know, whatever your feedback is right now, this way that you're thinking about approaching it, or what you're promising, you're over promising, right? So there's got to be this healthy respect across all the functions. And if somewhere that's not there in the team or in one of the team members, that for me is a flag, because I haven't found a way to fix it.
You just described me, Jennifer, in the early part of my entrepreneurial journey. I was an engineer and I was always way too early.
Yeah.
Wonderful. I think the theme that resonates, or the one word that sticks out to me, is self-awareness, right? Everybody having that self-awareness of what are their strengths, and then how does that play into the larger, you know, team composition. So one question I wanted to ask is, you know, does that process change, or does the due diligence process change whether or not you're a lead investor? And so I'm wondering if someone could speak to that element of it. Payal, if you'd like to jump in and just talk a little bit about that.
Or so we only lead or co-lead the Series A, which means that we are trying to complete our diligence in a way that we can submit a term sheet to the company, which means that we need to arrive to some sort of notion of value or valuation for the company. All of our investments are priced rounds, meaning that we do ascribe a value to the company, as opposed to doing sort of a convertible note or something that may happen and sort of the even earlier stages like a seed or pre-seed. So therefore there is I think a stronger level of diligence, and in terms of what we can diligence. I mean, there may not be, a lot of revenue or models, but we are going to look at everything from sort of market to customers. We do a lot of customer calls because in the absence of revenue and financials, our best endorsement or way to understand is by talking to your customers. We'll also leverage our network to talk to potential customers and hopefully introduce you to a couple in the process. But then also we're really just vetting from the experts in the market. Because at the end of the day, the question for us is there a market opportunity here? And how fast can it go, right? So that's what we're trying to assess. We'll spend time on the team, and that's mostly done by spending time with you and sort of in that dating process. And then, whatever else is available. It really depends on sort of the level or the nascency of the company. But yeah, I mean, it's a thorough diligence process. We're trying to arrive at a valuation. Now, that's the science or hopeful science. And then there's the art around valuation. I think really VCs are trying to get to conviction. And if we have conviction, then we're going to be trying to get a deal done. And it's a negotiation. And where does that trade cross, right? And so one way to think about valuation is the science. And the other way to think about valuation is we have ownership parameters. We're going to invest anywhere from 2 to 7 million into your Series A initially, and then reserve capital. We need to own, ideally, about 20% of your company. So we're going to be striving for conviction. That's the diligence. And then we're going to be striving to make that math work in negotiation with you. And the negotiation is an important part of the diligence as well, because we're going to be on opposite sides of the table, but how do we do that in a way that allows us to end up on the same side of the table and work effectively together? So yes, I think when you are at the earlier stages and you're co-investing and you're syndicating a lot and you're not ascribing the valuation, it's a lot more focused on the team and the market, but we have to really sort of cross our T's and dot our I's.
Wonderful. So one of the questions is, do you have a rubric for that specifically, or is there specific criteria that you're looking at as you make that decision?
Yeah, I was about to answer that on the chat, but I actually do have a scoring rubric that I use for myself. And frankly, it's more to just decide where I'm going to spend time. Because the one thing about this business is that there's always more demand than supply. And, folly that I just put my email address on there and I know I'm going to get flooded by emails. And so it's a question of where do you spend time? Right. And so I use a rubric for that, but ultimately, diligence is going to be the key.
Wonderful. What I would like to do is switch paces a little bit. I think many of us are probably having the question of how COVID has impacted the investment landscape. So I'd love to talk a little bit about that. I think, it's definitely shifted the way many businesses are operating. It's shifted, I'm sure, the access to capital and other things. So I would love for the panel to discuss how COVID has impacted the investment landscape. So Nancy, would you like to jump in and then can,
Sure. Well, I mean, one thing when we were prepping for this panel, I kind of told a story of a company that we were definitely actively engaging with. We had started introducing them to our customers, and then COVID hit, because indeed, just like Pal mentioned, we were testing our customers' interest in their solution, right? And then COVID hit, and they rapidly pivoted in such a state that it left us kind of backtracking from our customer as to, where are these guys kind of thing, which was not, it sounds more extreme than it was, but very much, we were talking, and in the chat, there's a lot of, what's a red flag? Flavor of the day solutions that you can apply your technology to is a big red flag for me. And I think that has occurred, at least initially in the COVID response. A lot of people were trying to shift themselves into COVID response because they saw that as, a hockey stick market opportunity and some of these things, but they didn't even really have a product yet. Or they were trying to morph a product that took them away from that area where they were passionate, where they had a network. And I think that's the wrong way to go. Particularly if your team doesn't have any expertise in healthcare. I saw all sorts of things like that very quickly. And that, at least from an investor's perspective or a long-term technical collaborator's perspective, which is oftentimes more the position that BAE is in, where we have an existing market that we understand intimately well. We have the ability to help them prototype and demonstrate, and we have customer access. So when we're bringing you in, I don't need you ping-ponging all over the place, so that we can collaborate. And so we simply turned away from those opportunities in the short term.
Okay.
Well, and frankly, the long term, we kind of axed them off our list, frankly.
Yeah.
So I have a couple comments here. The first is, well, how are investors responding? I think you saw in the spring, everybody sort of took a step back. The first thing we had to do was work on our own portfolio companies and try to make sure that they were well positioned to ride through the period of uncertainty. People made investments and did convertible notes to help that. People had to figure out within their existing investments who really warrants future and additional support here and what's that going to look like. And then from there, as we move through the summer, we see people really getting active and getting used to this new environment. And how do we build trust right away when we're mostly talking on Zoom instead of sitting face to face, which we're used to. I think you're seeing that people get more comfortable with that and deals are getting done. So you should take heart that deals are getting done. And then I would just say, I think Nancy's right about the pivot. There are two kind of reactions to COVID that I saw within startups. One was, or maybe three. One was, I just got sideswiped. My business is totally messed up. I had something that was really dependent, like a restaurant facing thing or a hospitality company, really dependent on the new market. And I don't know how to fix it. So I saw some people just flail.
Yeah.
I saw people really creatively figure out how to respond and do something differently, maybe even a little opportunistically, but that was still in line with their strategy and their core expertise. Those were the ones that were very interesting, right? And then we saw a lot of people just say, well, we'll just be totally opportunistic and we'll try this that's totally out of our wheelhouse. And I think for an investor, that's a little bit of a risk unless it happens to go wildly, wildly well, because we just don't know what it looks like as we come out of this. And if you're way out of your wheelhouse, our question will be, is that sustainable? So
yeah,
that's the way I think about it.
There are a lot of questions on chat about, how entrepreneurs should, manage the financing process. And I think that dovetails into this COVID thing as well. So, fundamentally, entrepreneurs to raise money have to create FOMO, right? There's sort of FOMO, fear of missing out, right? And it's really hard to do. It's a different kind of sales process than selling product to customers. How do you create FOMO? How do you get Pyle or Jennifer or Nancy or me, really excited to move quickly because somebody else might take the deal, right? And it's hard to do. Externalities like the pandemic really help you with that. And so if I think back now, about a third of our pipeline pivoted to COVID. So this is in deep tech. So a lot of, people who are doing diagnostics or therapy, pivoted to COVID. And the thing was they had like an 8 or 9 month window. And so in that, if you pivoted quickly and had a good story, you had a shot, especially at non-dilutive funding, because there's a massive amount of non-dilutive funding that, flooded the market, right? The RADx program with $1.5 billion and a bunch of disease foundations and others. But it's too late now. So, if you're trying to pivot to COVID today, you've already missed kind of the window. RADx, for example, has received 2,500 proposals now, and this is a program that was started in April. So, it's a lot about kind of externalities of what's happening in the market to create FOMO, and really you have to demonstrate why, your solution is the right one for this, situation, whether it's a pandemic or it was a .com boom, right?
So there are a bunch of questions in the chat related to, and some concern that we're addressing things that are later stage than most of the people on the call who are just trying to get their first check.
Sure.
So,
or even just get in front of us. How do you get?
And how do you get in front of us? So two thoughts there. First, I want to call out Pyle's great comment about bootstrapping, and that not every company is a venture company, and really know what you want and what fits you and where you live. The second part is about how to get in front of us, and there's also a question in there about would you ever fund a certain type of company? And there I would say, there are hundreds and hundreds and hundreds of investors, although they can be hard to reach, and there's fewer of them than there is demand for companies. But each of them has the types of businesses that they invest in and the specific criteria for their fund, right? And that for you, as much as you do customer discovery work to find out what are the right customers, if you're starting to go after your first check, the first step of the process is investor discovery, where you need to really go out and try to find and network your way to people who care about the thing that you are doing and who fit where you are in terms of stage, where you are in terms of type of business model, and what you are doing in terms of company. And then the best way is to try to network your way to a warm introduction.
And Jennifer, I would add that you also want to make sure they're not on too many boards, because if the general partner you found is already on 7 boards, it's very unlikely that they're going to make another investment, right?
I think that depends. I mean, we will, for great investments, we will, bandwidth aside, we will make them. But yeah, no, I think it's the hardest part is how do you get even the mind share? And I do think COVID helps in that sense. We're no longer spending the time traveling. So all the time that I was spending on planes and all of that, I can now hear, yet another Zoom pitch, which is helpful, although there's some Zoom fatigue. So you've got some good dynamics going for you with COVID. But again, I will bring this back to sort of the dating analogy. I mean, it is hustle. It is like, how would you meet that person? You'd either get an intro through a friend, you'd go sit at a bar, which could be, really low probability, but you'd go do that. And you got to find your way to us, because we are already, we have no shortage of things that we're looking at, but yet we're still looking for the best things. And all of us are looking for that. So I think, and part of that, and why do we make that process so hard? Like, why don't we make it so democratized? Because part of your ability to get to us is part of the evaluation criteria in some ways, right? Like, can you find your way in an interesting way to us? Tells us a bit about your hustle. It tells us a bit about your network. So if you're in some ways, I do think these things work out to be like, the universe. If you've got the right set of network and right set of hustle, you get to the right set of investors and right set of people. So there is some sort of, thing to that. But yeah, no, I appreciate the questions on how hard it is to even get in front of us. But I think we're trying to do things more holistically in the ecosystem to make it more democratized for you to get that access.
Yeah, I certainly think there's another question in there. And since I work with a lot of accelerators, what is the value of an accelerator? I think it really depends on you as a company and what you feel you need. I find the best of them can be very helpful. And there's an interesting thing in Boston as a very deep ecosystem that we almost have a tiered process. You can bypass them all if you have the wherewithal, the hustle, and you're getting to customer fit, and you can get access to the investor network and jump right to Pile or Pillar or some of the other seed investors in town. But you also can go through a university program, through Mass Challenge, which takes no equity, that helps prep people and prepare people. Then we have the Techstars accelerators, and we are starting to have a number of others that are specialized on certain types of technology or products. And I think those can be very useful because the goal of them is to be conveners of expertise, right? And then when you have access to that expertise, you're expanding your network, and that's making that process Pile just described of hustle and getting to people just a little easier. So maybe it improves the velocity for people. But I'll also give you the story of, I think they'd even be okay if I tell their name. One of the Mass Ventures investments, the last one I teed up, which was actually completed by Charlie Hipwood, was Fair Market IT. And Fair Market came through as just a deck through our website, which we always look at, but it's more rare that you, that always those get response, because if there's not also a call or some other hustle to get to us, then it's not as active a method, right? Well, this person started calling me basically every other day for 3 weeks. And I said, okay, I know there's something there now that I've revisited the deck, and I've picked my head up, and I said, I'm going to respond to this person. And we had a great conversation, and I felt like there was something maybe there, but I don't know the procurement space very well. But I knew somebody who I thought might. And I said, you know what, you need to have a conversation with so-and-so. And I find this interesting enough that I'll make that introduction, because I need to have somebody else validate this.
Validate it, yeah.
Yeah. And then I got a call that afternoon from the so-and-so. And he said, this is the weirdest thing. I just got connected about this young entrepreneur, and someone from my firm who I really respect called me about him, and you called me about him in the same day. And I thought, check box 1. Okay, he's just made it further through my process, because that's hustle for days. Basically, he left me just dropping this person's name. He found a way to get the intro from me to the person, and he went through his own network and found another intro to that person and triangulated them, right? So that was the first step of like, oh, I'm going to be a little more interested here, because he's demonstrating something that's kind of rare. And from then it just evolved, and it actually took about a year of working with them through they're trying to get their pre-seed funding, proving some product market fit before it really was a fit for Mass Ventures.
So Jennifer, I want to ask you a question about and the panel about the accelerator. So what are some things that individuals should look for in an accelerator? Because I'm assuming that not all accelerators are created equal. And so, you know, if I'm an individual who's evaluating what's the right accelerator for me, what are, you know, some of the things to look for that would be positive, and what are some red flags for, you know, in evaluating those accelerators?
You know, I co-founded an accelerator called Learn Launch,
Sure.
right, which is specifically for EdTech.
So
the important thing is to understand that accelerators are basically 2 groups. There are horizontal ones like Techstars, right, that accept all kinds of technologies. And then there's vertical ones, like, you know, and Techstars has got some vertical ones too, like the Air Force Accelerator, and Learn Launch is a vertical accelerator. Mass Challenge Health is a vertical accelerator for digital health, right, Pyle? So, you know, fundamentally, you go to finishing school if the school that you went to didn't do a good job.
Okay.
That's the way I think about it. So, many of these entrepreneurs go through entrepreneurship programs in their undergrad, and then they feel like they need to go to an accelerator. And I think that most of them go through the accelerator not because they need to learn more about the process of doing a startup. It's because they feel like it's a signal to investors. So remember, there's a demand-supply mismatch. And the earlier stage you go, the demand-supply mismatch gets bigger. So there's much more demand at pre-seed than there's supply. The further out you go, when you're at Series C and Series D, the demand supply gets closer. And so you go to an accelerator basically to differentiate yourself in demand, right? That's why most people do it. And it's very clear that accelerators are branded too, so Techstars has its own level of branding. Y Combinator is even, a higher kind of branding level. Honestly, as an investor, I just don't buy into all that.
Yeah, I think the other way to think about that is just like we do diligence on you, when you are looking for funding and you're doing that investor discovery process, you also are going to do some investor vetting. And the way you do that is you talk to other people who've been funded by that investor. Now, most of the time, everybody's going to tell you great things, but you do want to go and meet the other entrepreneurs who have worked with that fund and find out what they think they're strong at and what maybe another fund was stronger at, and see if there's things there that really seem to fit you and what you think you might need. And I think you do the same thing with the accelerators.
Wonderful. So the time is 10 o'clock. So what I would like to do is, and we've started already somewhat in the process, is take some questions from the audience, again, to make sure that we address, anything that has come up. So let me see if I can scour the questions and identify one.
There's that provocative question, name the one that got away.
Yeah, okay.
And name the one that you regret. I don't think any of us are going to sort of answer that piece, but name the one you regret. But I'll name the one that got away. So we had an opportunity to be in the Series C of Carbonite, and David Friend was somebody I'd known, and he was mainly focused on the West Coast, but we had a shot as an East Coast investor, and I just wasn't able to put an argument together for my partners to invest in it, and that was obviously, in retrospect, a mistake.
We were investors, and are investors in Carbon Black, and one of the employees at Carbon Black was Drew Houston, left to start a file sharing company that this predates my arrival to 46, but we just didn't. It was really, really early, and we didn't invest in what became Dropbox.
Nobody on the East Coast did, right?
Yeah, even though he was right here in our town.
Nancy, any investments that got away?
None that are good stories like that, to be honest. I mean, yeah, there are things where I'm like, oh, I guess I should have looked at that a little more closely. But I'm young enough in my cycle of investing, right? That there are things that are still untold but seem to have legs and things, and it's I don't know what the outcome's going to be, and I'm sure someday I'll be like, oh, I really should have done that. But yeah, there's not one that distinctly comes to mind like missing Dropbox or Carbonite. I mean, those are big ones, guys. I can't compete with that.
I can think of two smaller ones where the jury's still out, but
yeah.
I used to keep a list of the things that I thought were compelling and I didn't get over the wall, and the things that I woulda, shoulda, coulda.
Mm-hmm.
Just so I could keep myself honest, right? So Board Prospects was one that I met in my first days at Mass Ventures, and I'll admit that I passed because at the stage the valuation seemed high for me. for what I had been told the parameters were at Mass Ventures, and but they've gone on and been wildly successful. And basically, they were building a LinkedIn for people who were potential board members, and they weren't clear on their model. They were just trying to aggregate the people and quality people, and then it became clear that people would actually pay to be a member of this thing. And that's when it took off. And now it's backed by NASDAQ and NYSE, and they have all the major board directors on their platform. And so that's been quite a success. And the other where the jury's still out that I found compelling was SYNAC, which is the white hat hackers. And I remember running back to Jerry's office and going, it's like applause, but with hackers. And then both of us being like, how do you really know they stay white hat? And we just couldn't do it with the state's money. So.
Well, actually, a really great question came through further on this topic. So, do you view East Coast versus West Coast? Is there a difference in how particular regions view investment decisions? You mentioned Dropbox, being in our particular area, but still, it found investments in the West Coast. So, are there, does the geographic location play an impact in how investors view a particular investment? Or is there an appetite for particular industries within a particular geographic location?
I personally, I actually think it's, although we hear that a lot, I think it's less industry specific or style specific, but I think there are two things that are a little different. One is that the sort of velocity of the network and the velocity of capital on the West Coast is higher. There's just been more. And that tends to create, there's more people seeking money, but there's some more money flowing. And there's a place in there where that tends to create that valuation bump where people might say, well, here in Massachusetts or on the East Coast, we're a little more conservative on valuation. We're a little more fundamental in terms of looking at the progress that the company's made. I think there's some truisms in there, but I think it's a nice balance to what you have on the West Coast, because as markets move and things shift, that place of having a little more conservatism can be really valuable.
Yeah, I just posted to the chat that I think it's really good to have investors from both coasts, because they're playing in different market pools, and especially for exits, I think it's really important. When we were launching Aperion, when Chuck Goldman and I were launching Aperion, I told Chuck, I said, nobody in Boston is going to invest in us without a business plan, right? He had been at Apple. We had, the iPhone had just come out, and we were just thinking about, we didn't know what the product was going to be, but we wanted to be in the space. But we got, I think it was Accel and Sequoia were ready to invest just on the basis of the team, but we had to move there in order for it to happen, and for personal reasons we weren't going to do that. And it actually turned, well, we ended up, Common Angel, I've forgotten what the name is now. Common Angels.
Common Angels, yeah.
Yes.
It was Common Angels. It's a long time ago. Yeah.
So they came in, and then, and then Northbridge, and so it turned out like reasonably okay, but so I think that's kind of what Jennifer is referring to. The velocity of money is faster there. People are willing to make quick bets on people, but I think as an entrepreneur here in the East Coast, even in life sciences, I would actively seek out investors in California as well.
Yeah, we like to bring them in on the later stage rounds. I just think on the earlier stage rounds, to Vineet's point, there is a geographic proximity issue. So if you're a Boston-based startup, I mean, you're more likely to sort of, at least for those very early rounds, get the investors that are closer to you.
Gotcha.
And frankly, you want that if you've got active investors, right, that are actually advising you and trying to help your business to succeed. You need your local network. There's an advantage to local proximity investing, frankly. But yeah, I agree. I think as you get more mature, this has been an age-old debate, what's the difference between East Coast versus West Coast VCs? And there is a culture difference, but the fundamentals of a good business, a good venture-backed business, are ultimately the same. And I think that that's what people forget, right? They go, well, you know, who's going to be more amenable to my idea or to my team, et cetera. You still have to have the basics in place. You still have to have the high exit opportunity, rapid growth, you know, capability, and some of these other things, or you're not a venture-backed business. And that's the one thing I think everyone on this panel has already kind of discussed is maybe you don't need a venture round. Maybe you need some angel, right? Or maybe you don't need anything. Maybe you need non-dilutive financing to help validate your technology. And then frankly, you can sell it to a BAE, right? Because it happens to fit into our current technology development pipeline. So really understanding what you are and what you're building for at exit, or maybe you're building not to exit, is really what you need to fundamentally understand about what about your business and what kind of financing you ultimately need, if any.
Yeah, gotcha.
There was a question about board composition. You know, these early stage boards, I think it's incredibly important, especially as you bring investors on and sort of investors join your board, is to have a gray-haired independent, and that gray-haired independent should be an expert in the market that you're addressing. And frankly, I think you as the entrepreneur founder should go and identify that gray-haired market expert and bring them onto the board yourself, and not wait for the investors to do it. Because
Give you one.
Yeah, because most of the difficult decisions in these companies, most of the big strategic companies require market knowledge, and most investors don't have it. I mean, they can't possibly get very deep in any one area, so they'll fall back on this independent, and you want that independent to be in your pocket.
If you're in the pre-seed stage before you're really building a board or have that first investment, assembling that group, a small, tight group of those types of advisors, and then really learning how to use them can be really valuable. And you can think about that group around both board industry expertise and maybe functional expertise that your team doesn't have, having your sounding board of people that you can go for that. There was another question about groups that charge founders money for intros to investors, which in later stage companies, that's called investment banks. And investment banks play a really valuable role. I'm not a fan of those personally, of the things that charge you money and promise intros, because again, I think it's really it's part of your business to learn to do this selling as much as selling to customers.
Yeah, there's one group that's been charging, you know, entrepreneurs to pitch, you know, and they've been around for years and they keep growing and growing. I hate these guys. Like, it's, you know, entrepreneurs don't have money. It's not fair to charge them to go pitch.
Okay, appreciate that. I want to make sure we end on time. So what I would like to do is just take an opportunity for you all to present any last final thoughts, major takeaways that you'd like the audience to leave with from today's conversation or today's panel. So Payal, I'll start with you and then I'll make my way down.
Thanks, Varun, and it's a great discussion, everyone. I think I'll step to high level with two thoughts. One is making sure that you really identify the fund or funds that are going to be good fits for you, and sort of treat this like a sales process to customers and really prospect appropriately. I think that'll give you a better chance of raising that funding. And then two, we hit on it a little bit. We don't talk about it often enough, but do you really need to be venture funded, or are there other more exciting ways for you to ultimately, you know, own your business, become rich, and build a great company that changes the world? I think, you know, as much as we love to see every company come to us, we want to make sure that ultimately your business succeeds and sees its ultimate fruition. So make sure you think through all those different options, including the non-dilutive ones.
Nancy?
Well, Payal stole my think about your business and where you actually want it to go. Yeah, I mean, one thing that I think we also touched on today that maybe we didn't harp on enough is creating a sound group of advisors with a variety of different expertise networks that can help you get to where you think you're going, but also are willing to spend some time with you, what I would call stress testing some of your assumptions in your business and your model and your financing and your ability to accomplish certain milestones. It is worth thinking about getting a set of what I would call business advisors and technical advisors. If you're a highly technical business or industry advisors, you need to make sure that you as all people have certain biases that you simply don't see or are not anticipating because of where you're currently sitting. And it behooves you to think hard about who you can surround yourself with that's going to give you that visibility and that understanding. At the same time, if someone is toxic, right? And you go, oh, but they introduced me to this great guy. But if they are toxic or they have you constantly circling, know when they're not a good advisor anymore. And keep in mind that this is your business. You have founded this, and it is okay to jettison people who no longer fit with what your objectives are. I've seen a lot of people keep advisors that are literally toxic. They will badmouth you to other investors, etc. In which case, you need to address that, not just hope it will go away over time.
Vineet, and
Yeah.
just
So there's two ways to raise money. There's a shotgun approach where you have a very large prospects of VCs and you start, like a sales process. Or there's a rifle shot approach where you do all the work up front and figure out who are the right individual general partners that you want to approach. Either way, you have to be prepared, and you have to be prepared with materials, right? So you want a really good one-pager. The goal of the one-pager is to get you the meeting to pitch. You want a really good pitch. It should be 10 slides, 11 slides. And the goal of the pitch is to get that investor interested enough to start spending time with you. And then you should have your diligence material ready. So your personal references, your financial models, all those things that the people are the more ready you are, the more impressed the venture capitalist is going to be, and the more you're going to create FOMO.
Wonderful. And then Jennifer, any last remarks?
Oh, I think everybody's pretty much covered it. I guess I would say the last fundamental pieces are hustle and process, right? Okay. So once you set on the path to do this as an entrepreneur, I once heard Gene Hammond describe it as you're trying to move 1,000 pennies up a hill and not let any of them fall down, like roll them up the hill. And when you start this process, if you decide to go after investment, you want to really, target the window that you're going to do it so that you'll still have enough cash to get through it and cash at the end. And then you need to start and run hard. And I've made this mistake myself. So it's start and run hard and have enough process that you don't drop the ball on it once you enter it.